What if your investments could pay you regularly without you having to sell them? That's the part of investing most beginners overlook. Because building wealth isn't only about watching your portfolio go from $10,000 to $20,000. At some point, you may want your investments to actually produce cash flow. And there are several ways to do that. But here's the problem. The investment offering the highest yield isn't automatically the best investment. A 10% yield can look incredibly attractive until you discover why you're getting paid 10%. So in this video, we're going to break down 5 ways investors can potentially generate regular income from their portfolios. We'll start with some of the more conservative options, then move into dividends, bonds, and real estate investments. And most importantly, I'll show you what to look at before you chase a high yield. Because earning income is one thing, keeping that income sustainable is another. Let's start with one of the simplest sources of investment income: interest. If you keep money in certain high-yield savings accounts, CDs, or U.S. Treasury securities, you can potentially earn interest on that money. For example, Treasury bills are short-term U.S. government debt securities. They're not designed to make you rich overnight. Their appeal is different. They can provide relatively predictable income while playing a role in preserving capital. But then we get to one of the most popular sources of investment income: dividend stocks. When you own shares of a company that pays dividends, the company distributes part of its profits to shareholders, so you can potentially receive cash while continuing to own the shares. Sounds great, right? But this is where many beginners make a mistake. They sort stocks by dividend yield and immediately choose the highest number. That's dangerous. A company paying a huge dividend doesn't necessarily mean it's a great investment. You want to look at things like free cash flow, earnings, debt, payout ratio, and dividend growth, because a dividend is only valuable if the company can realistically afford to keep paying it. Next, let's talk about bonds. When you buy a bond, you're essentially lending money to an issuer. In return, you receive interest according to the bond's terms. But bonds have risk too. Interest rates can affect bond prices. Inflation can reduce your purchasing power. And corporate bonds carry credit risk. So again, the goal isn't simply finding the highest yield. It's understanding what you're getting in exchange for that yield. Now let's talk about REITs. REIT stands for Real Estate Investment Trust. Instead of personally buying an apartment building, office building, or shopping center, REITs can give you exposure to income-producing real estate through publicly traded securities. Many REITs distribute income to shareholders, which is why they're often considered by investors looking for portfolio cash flow. But here's the bigger lesson. Regular income does not mean risk-free income. And this is something you need to remember every time you see an investment promising an unusually high yield. Ask yourself, where is this income coming from? Is it supported by strong cash flow? Is the company carrying too much debt? And what could cause that income to fall? Because a 10% yield isn't automatically better than a 3% yield. If the 10% income disappears, while the 3% income continues for decades, which investment actually helped you more? That's the mindset you want to develop. Don't build your portfolio around the biggest number you can find. Build it around sustainable cash flow, diversification, risk management, and long-term growth. Because the ultimate goal of investing isn't just to own more assets, it's to build assets that can potentially work for you. And when your portfolio starts generating income, you stop thinking only about what your money is worth today. You start thinking about what your money can produce for you tomorrow. That's when investing starts becoming more than wealth accumulation. It starts becoming financial freedom. This is Capital Coach. And remember, don't just build a bigger portfolio. Build a portfolio that can pay you